I hear you're big into fantasy football.
It started innocuously as a way to keep in touch with college friends. It's since been a great training ground for investing. Trading with league mates, I feel so prepped for term sheet negotiations with Dynasty. You're taking bets on rookies and young players in the same manner that you're like betting on startups. Product market fit is defined as people who are willing to pay for your product. But the reality is, product market fit isn't a binary, you have it or you don't. It's really applied to different pockets or segments of the market, right? And then within each of these pockets or segments, you can sort of model it out with like logistics or S-curve of like you start and you ramp and then you saturate, right? And you have to like tack on additional markets, tack on additional products, etc. We win when our community wants us to win, and purpose is the key to profits. Hey, let's just like be very radically transparent about who we are, what we do, what we care about. That's not going to appeal to everybody. The goal isn't to appeal to everybody. The goal is to find the set of founders building the sets of categories that we want to partner with and be the very best partner to them.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to Run the Numbers. Today I'm joined by Jason Kong, general partner at Base10 Ventures, where he leads Series B investments with a focus on what they call automation for the real economy. That's the software powering industries most tech people don't think about, but the world can't run without. Jason's background spans private and public markets. We get into what makes the Series B stage so unique, how he spots breakout potential in back office software, and whether vertical SaaS has crossed the line from niche to overcrowded. But this isn't just about investment theses. Jason and the team at Base10 also do something pretty extraordinary. They donate 50% of their profits to fund scholarships for underrepresented students. We talk about how that model came to be and how it shapes the way he thinks about value and impact at the same time. Oh, and stick around for the lightning round because we cover fantasy football draft strategy, his time shorting SaaS in 2022 as a hedge fund manager, and the one thing he thinks about venture that might get him kicked out of the group chat. All this and much, much more after a short word from our sponsors. You just launched a new AI product. The new pricing page looks great. I'm talking crisp. But behind it, last-minute glued code, messy spreadsheets, and running ad hoc queries to figure out what to bill. Customers get invoices they can't understand. Engineers are chasing billing bugs. Finance can't close the books. Well, with Metronome, you hand it all off to the real-time billing infrastructure that just works. Reliable, flexible, and built to grow with you. They turn raw usage events into accurate invoices, give customers bills they actually understand, and keep every team in sync in real time. Whether you're launching usage-based pricing, managing enterprise contracts, or rolling out new AI services, Metronome does the heavy lifting so you can focus on your product, not your billing. That's why some of the fastest growing companies in the world like OpenAI and Anthropic run their billing on Metronome. Visit metronome.com to learn more. That's metronome.com. Here's a growth tax nobody talks about. Every new monetization model you ship creates a nightmare for your finance team. Add usage-based pricing? Now you're tracking consumption against commitments. Launch product bundles? That's multiple performance obligations per contract. Offer mid-cycle upgrades? Woo! Good luck reallocating revenue manually. The irony is brutal. The pricing innovations that drive growth are the same ones that often break your finance process. But that's exactly where RightRev shines. RightRev is the revenue recognition engine built for companies that can't afford to let accounting slow down growth. Here's what most people miss, and I've come to deeply appreciate. Revenue recognition isn't just a finance problem. It's a go-to-market enabler. When your rev rec is automated, your product team can ship new pricing without asking finance for permission. And your sales team can close creative deals without worrying about downstream chaos. To get up on my CFO soapbox for a sec, I love talking about creative pricing models, hybrid pricing, credits, tiered usage. It's where real growth happens. But I've seen too many companies where the sales team is celebrating a huge quarter while finance is still trying to figure out how to recognize half of it and crying in the corner. RightRev lets you experiment with pricing without wrecking your close process. And honestly, in a world where your pricing model might change 3 times next year, that flexibility is everything. If you want to scale your monetization without breaking your books, visit RightRev.com. That's RightRev.com, where modern monetization meets bulletproof accounting. Being a CFO, you know how much I love tools that actually make the lives of accounting and finance folks easier. One of my favorite tools right now is Rillet, the AI native ERP going head to head with NetSuite. Yes, someone is finally doing it. I met Rillet 2 years ago when they were still in stealth. Since then, they've absolutely taken the finance world by storm. Their mission is to make the zero-day close a reality, and they're actually doing it. Customers are literally closing their books at 1:35 p.m. on the first day of the month. They've got everything you need to scale your business. Complex revenue recognition, native integrations, custom reporting, multi-entity, close management, and much more. They're only a few years in and are already supporting NASDAQ publicly listed companies. Yes, seriously. If you want to scale your business on an ERP that wasn't built in the 90s, you need to check out Rillet. Book a demo at rillet.com/CJ. Oh, cool, that's me. That's RILLET.com/CJ. RILLET.com/CJ. Tell them I sent you there. Jason, it's great to see you, my friend.
Excited to be here.
We've been connected for a while, so I feel like we've been circling, and it's about damn time we do this podcast.
Yeah, the reach has just grown incredibly, and it's great to see, both on the podcast side as well as on the newsletter side. I was envious of a couple of my friends who are on early on, but I feel like I'm catching you at this inflection point. So I'm really grateful.
Well, I'm grateful to have you here. I know you're a busy guy, and I've been keeping up with Base 10 for a while. And if I have it right, you focus on what you call automation for the real economy. And I think that means you're going after companies who are selling to non-tech industries. I'm hoping you can elaborate on what automation for the real economy means. And I know you're enthusiastic about it. So why build a whole strategy around that slice of the world?
We, as a firm, have only been around, really started 2017, first fund sort of raised and closed 18, 19. So 6, 7, 8 years at this point. From day one, the strategy was always really around automation for the real economy. And it's funny because when our co-founders actually went to pitch the fund to LPs, it was AI for the real economy.
No way, in 2017?
Yeah, if you were like AI is not a real thing, that's a fairy tale, and so we had to ground it more in reality with automation for the real economy. But I mentioned that because both that automation piece, the AI piece, as well as the real economy focus has really been there since day one not that long ago. Today, we're a $2.5 billion AUM fund. We sit cross-seed through Series B, and as you mentioned, the unifying focus is really automation for the real economy. What does that mean? It is finding, productivity gains, selling automation, selling workflow into most notably non-tech end customers. And why do that? What does that look like? I think it's really two pieces here. One is, so much of venture gains over the last 5, 10, 15 years have been tech building for tech, right? When we think about cloud computing, when we think about DevOps, when we even think about some of this current AI infrastructure tooling, it's really, hey, who are the tech leaders, who are the innovators, and how do we serve them? When we look overall at, what moves the needle, not just from a return perspective, but from sort of a global productivity gain perspective, there's still huge swaths of the GDP, upwards of 85, 90%, that sit outside of technology. You want to look at it from a market cap perspective, if you think that's more correlated to, earnings power, still 2/3 plus of US markets, 3/4 of global markets are these non-tech end customers. And when you think about the market opportunity there meets sort of this like S-curve of adoption, it's like, hey, I remember 10 years ago, we were talking about where is cloud compute adoption and how many workloads are in the cloud. And it's always an asterisk. It's the net new workloads on the cloud that are, 60, 70, 80%. There's still an overall set of workloads that have existed, whether that's mainframes for banks, whether that's, on-prem servers that is still on the flow of shifting, right? And so our focus is, hey, that's all going to come online over the next, maybe 5, 10, 15, 20 years. But how do you really serve those customers? How do you accelerate their technology adoptions? Huge part of the market, less focused on, I would say, than, where Silicon Valley typically sits. And I'm sure we'll talk more about that. I just think it makes much more tangible difference in we call it serving the 99% sense, right? So it's really tech broadly applied in a manner that's accessible by much more than your Stanford grad developer or what have you, YC founder.
And is real economy synonymous with vertical software, or is it just an overlap?
Real economy is certainly meant to be broadly encompassing. And again, when we think about the 99%, I almost think about it as, hey, what is the persona of the buyer and how are these purchase decisions being made? And the reality is, I'd say 50% of our investments are probably around vertical SaaS and vertical AI, what have you. The other 50% is a little bit more of a grab bag, but I would say a big part of that is focused on workflow automation, even on a horizontal basis for the back office, right? So near and dear to your heart, sort of like office of the CFO technologies serving SMBs, broad-based payroll, HR. We also spend time in government and procurement and defense, safety, et cetera. So all of those, again, you can get the sense of very much touch folks beyond, tech innovators, leading adopters. And I think the other big part of this is when we think about what gets us excited about investing in this category, the last 10 years and even this time, we were sort of in a growth at all costs mentality, and that gets rewarded. I think what we really care about is this idea of defensibility and the durability of cash flows over time, right? And so the nice part about investing in tech for tech is, if you're selling to startups, they have lots of funding from venture capitalists, and you can sort of swipe the card and make investments in your marketing stack, in your finance stack, in your infrastructure, et cetera. And so you get this really fast, out of the gate growth for this initial product market fit. But again, you actually saturate that market at 10, 15, 20, $30 million, and then you have to cross the chasm. On the non-tech side, you're actually not selling to folks who, are buying for speed. You're selling to folks who view everything as a real expense, right? And so suddenly you're investing off of EBITDA, not off of venture dollars. And that means, the provability of ROI and that true product market fit, we actually think is much more evident for these types of businesses. And it plays out when you think about the compounding of the growth over a 3, 5, 7-year horizon versus that really fast, 1 to 10 momentum out of the gate, which we see sometimes, but I would say we index on less than the rest of the market.
I'm so glad you brought this up, because there is that old saying in Silicon Valley that companies get stuck around 15 or 20 million in ARR because that's when they run out of tech friends to sell their tech into.
There's this idea of product market fit. And again, I very much grew up, and even today I'm a Series B stage investor, right? So this idea of you're still early growth, but your post product market fit or product market fit is defined as people who are willing to pay for your product. But the reality is, product market fit isn't a binary, you have it or you don't. It's really applied to, different pockets or segments of the market, right? And then within each of these pockets or segments, you can sort of model it out with like logistics or S-curve of like you start and you ramp and then you saturate, right? And you have to like tack on additional markets, tack on additional products, et cetera. This is generalizing, but when you're, startups selling to startups, it is because the product market fit is so strong. But again, it's not a broadly applied TAM. It's, YC has done this super well. You sort of have a startup and then you sell it to every other YC startup and you have, a crazy 0 to 5, 0 to 10 growth story. But it's easier to hit the wall because, what you're actually selling and the ROI and how people make decisions changes as you expand the market, as you move beyond that core initial segment.
And listen, I'm terminally online and I live in these echo chambers where it's people like me and you talking about tech a lot of the times. But I remember when I got to Parts Tech, which was vertical software for the automotive sector, specifically for helping, mom and pop garages order parts for aftermarket maintenance. Somebody said to me, do you know this market is 7% of American GDP, the automotive market? And I was like, what? That's like a lot bigger than some of the other quote unquote tech markets that I came from. So it is eye-opening when you see how big some of these sectors are.
Absolutely. And again, we, for background of the audience, we originally met when you were at Sneak. I was in the public market side. We've continued to evolve our careers. So we overlapped in our Parts Tech, and now it's great to overlap again here. But I do think we, had these ongoing realizations around the same period, right? Like, hey, it's great to be at the epicenter and the bleeding frontier for technology. But when we think about what the opportunities could become, particularly relative to, competition and saturation and seeking out returns and alpha, it's like, wow, there's actually a lot here. And so at Base10, we feel like there's so much there to dig into and find and invest in. And our goal is very much to be the very best investor for businesses building for the real economy. And that is a very singular focus we're able to navigate towards every day.
Hey, thanks for listening. We'll be right back after a word from our sponsors. This next segment is brought to you by Tabs, a company I've been following closely for quite a while. And if you're a CFO or controller listening, this is one you should pay attention to, because this is where billing and revenue automation is headed, especially in a world of usage-based pricing. Ali and the team at Tabs are building something that directly addresses one of the biggest headaches I see finance teams deal with today: pulling data from your ERP, your CRM, your FP&A tools, and your usage systems and actually making it all work together. If you're running usage-based pricing or complex contracts, you already know how this usually plays out. Contracts live in one system, usage data lives somewhere else, billing happens in another tool. RevRec gets layered on top at month end, and finance ends up just reconciling everything by hand to close the books. It works for a while until close slows down, RevRec gets fragile, and wait for it, cash shows up later than it should. This is exactly the problem Tabs was built to solve. Tabs is an AI-native revenue platform built for controllers and CFOs. It brings together data from your ERP, CRM, and real product usage into a single system of record. From there, it automates billing, collections, and revenue recognition without finance having to duct tape workflows together every month. No CSV uploads, no manual reconciliations, no end-of-month fire drills. Companies like Cortex, StatSig, and Cursor are already using Tabs to scale revenue per employee, save hours every close, recognize revenue cleanly, and get paid faster. If usage-based revenue is core to your business, this is the future of how billing and RevRec get done. Go check them out at tabs.com/run. That's tabs.com/run. Now, if you listen to Run the Numbers, you know that I have a love-hate relationship with finance tech. We've all been burned. We've all bought that enterprise planning tool that promised the world, only to realize 6 months later that we've basically taken on a second full-time job just to keep the software running. I want to talk about a company that was built specifically to kill that cycle, Abacum. I actually remember my very first conversation with their founder and CEO, Julio Martinez, over 3 years ago. Back then, they were just starting out in Spain. What struck me most was his frustration with these massive legacy planning platforms that had long implementations, expensive consultants, and after all that work, you're still struggling to get answers and manage the system. He and his co-founder Jorge are both former CFOs. I knew I liked those guys. Fast forward to today, Julio moved the home base to NYC. They've raised over $100 million in capital from heavy hitters like Scale Venture Partners, and they're the engine behind finance teams at Strava, Replit, and JG Wentworth. When a company like Strava, where the data volume is massive, trusts you with their planning, you know the tech is robust. But here's why I really like them. Abacum doesn't turn you into a software admin. The integrations are actually self-service. You don't need a $300 an hour consultant to plug in your ERP or HRIS, and they're doing AI in a way that actually impacts the things FP&A teams are doing every day. Things like creating variance summaries, building formulas, and modeling scenarios. If you're scaling fast and you're trying to avoid that legacy platform trap, Abacum is the move. They're building the future of our tech stack, and they're doing it with a CFO's perspective. Go to abacum.ai to see it for yourself. That is abacum.ai. Well. Here's what nobody tells you about being a CFO. You'll spend 50% of your time on stuff that is killing your momentum. The best CFOs I know are business leaders who know how to drive growth in heroic fashion. But most of us end up spending our days buried in manual work. I'm talking about collecting receipts, reviewing expenses, and manually reconciling spend. It's painful. That's why CFOs need Brex. Brex built an intelligent finance platform that pairs corporate cards with built-in expense management, plus a team of AI agents to handle the manual finance tasks for you. That way, CFOs have more time for the high-impact projects that drive growth. You know, the shit actually worthy of your CFO time. Bottom line, Brex is automating hundreds of thousands of hours of manual finance work every month across 35,000 companies like Anthropic, Coinbase, and DoorDash. Ready to spend less time buried in expenses and more time driving results? Check out Brex at brex.com/metrics. It is brex.com/metrics. Please, guys. How the hell do I have 3 kids in daycare? Brex.com/metrics. So you donate 50% of the profits from Base10's investments to create scholarships at underfunded colleges for future tech leaders. How did that come about? Because it's amazing. And how does it shape how you think about return and impact?
At Base10, we have a lot of things that we say often, but the two relevant to this. The first is, we win when our community wants us to win. And the second is purpose is the key to profits, right? So I think both of these have the lens of, in our day-to-day, what we do is we seek to drive the best returns for our LPs. But as part of doing that, and actually core and essential to doing that, is having to focus on how can we give back? How can we drive purpose? How can we have a greater impact, not just for the 99% of the world that are using the technologies that we invest in, but even more tangibly. That was important to me when I joined. I'll share my personal background, but also important to our co-founders when they started the firm and we're building towards this, right? One of our co-founders, Ade, he was Nigerian born, raised in Spain, was one of the first Spanish internet entrepreneurs, sold a business, essentially the MySpace of Spain back in the 2000s for a pretty good exit at that point in time, right? And I think it was one of these things where technology really was the catalyst to changing his life. Founded some other pretty impressive startups. He came out to the Bay Area, studied at GSB, et cetera. But when you look around, his story and the rest of, just the folks around Base10, I think that is a commonality of, not folks that grew up in the Bay Area or folks who grew up around technology or around wealth, et cetera. And it's really technology as this great enabler and a great equalizer to help change the trajectories of families and lives and generations, right? And the path to do that is through education and through accessibility. Ade, when he became the first Black investor ever to make the Midas list, I think this was 2023, Alex Conrad wrote a really nice piece about him. And Forbes, when Alex was still at Forbes at the time, that very much talked about this like outsider mentality. And again, it changes how we invest in this real economic thesis as well. But the net of it is like, hey, it made such a big deal in our lives. For me, my parents grew up in the Cultural Revolution in China. I was fortunate enough to be born here. I went to school on financial aid on a named scholarship that made it meaningfully easier for me to attend college. And so now we look at it, we're like, man, how cool would it be if the companies we're investing in were able to take those proceeds and create the next set of amazing technology entrepreneurs, particularly when they might have not had that opportunity historically. We make these scholarships in the names of our portfolio companies that we invest in. And as they go public, like the Nubank scholarship, the Figma scholarship, et cetera. And then we actually do much more than the dollars and cents piece too. We actually have a whole initiative where we're bringing in college students from these universities and have them, have a fireside session with Sam Altman a couple years ago, or Dylan Field from Figma recently, et cetera. And so it's very much with this idea of like, hey, can we just increase the accessibility and then create more opportunities for folks, all as part of what we're doing within our core thesis and our core focus as well.
That's amazing to hear. I gotta give you guys your props for doing that. I'm curious if it helps founders think about like what they want to do with their companies, who they want to sit around a table with. Some of the founders you speak to, I imagine they have a strong reaction to that.
I think the focus of our strategy is really, it's to be focused and to have a very clear ICP, and then to just prove that we're the best partner for those founders, right? And I would say there's been an evolution where we have been less public about the giving piece. We've actually been giving more and expanded the mandate internally, but just externally, it's not what we lead with. But I think as we have conversations, it's just one part of the holistic picture of like actions matter more than words, and us revealing our essence of what matters to us as we go to founders. And like, wait, you're not just saying it, you're not just, another Silicon Valley firm, or not just another venture capital firm or private equity firm, et cetera. It's like, oh no, you guys are different. And I think we're different in a lot of ways, but I think this is a key one. A business I'm on the board of, Flare, the CEO Norma was very much like, wow, like that's incredible. Like they do something similarly in terms of, the Flare Gives program. And I think it's just very much a clear resonance with a certain set of founders that care about this, right? And those happen to be the founders that we want to work with as well. And so it's all in the spirit of, hey, let's just like be very radically transparent about who we are, what we do, what we care about. That's not going to appeal to everybody. The goal isn't to appeal to everybody. The goal is to find the set of founders building the sets of categories that we want to partner with and be the very best partner to them. So that's really where we see a strong benefit, even though that's obviously not the reason to do what I've done in the first place.
It feels to me like you're stacking different things that make you unique to create a one-of-one investment firm, which I love. And I want to get back to the companies that you invest in, what the shape, the feel, the characteristics. And from speaking to you in the past, I think it's about 50% vertical software and AI, 40% back office, and 10% across climate, gov tech, and defense. And it sounds really disciplined, but it also, that's still a wide aperture. What are you seeing as the most overlooked alpha right now? What's getting you the most energized to look at?
It's funny you mentioned, stacking the things that make us N of one. I think that is true in lots of ways, even as I've been around venture and talked to peers and GPs. But I think it's really just like being true to who you are, right? Like we do everything because we think just from a first principles perspective, it makes sense. And that's how we got there. And it just so happens that other people are different or following different strategies. And so there's not that overlap. Another part that is different for our strategy is we very much think and approach thematic investing like a hedge fund, right? Which is to say, like, we're not dogmatic about the, that split that I shared, which just happens to be the current split within the Series B, but it's very much this lens of like, hey, where can we be ahead of consensus, but still right? So call it ahead of consensus by 12, 18, 24 months, whatever it is, where consensus is, call it more evident in the public markets, but like what all the other investors believe and sort of plays out in multiples and competition and, how far ahead people are willing to pay or what the, resulted cost of capital is, right? And the manner that we try to find these non-consensus opportunities is through going very deep thematically, again, like a hedge fund. I most recently came from a hedge fund. One of our other co-founders came from Co2 and founded the private practice at Co2. And so, that's a big part of the DNA as well, where it's really getting into, hey, from all the way from like pre-seed from seed, like what are the changes that are happening from a buyer needs perspective, from a pain points perspective, and then like where is that showing out and inflecting growth, and then leaning into those categories. An early realm of that has been this like software enabled like climate and grid resilience lens. Obviously, like these things happen fast. So like 18 months later, there's been an incredible amount of investment in power and energy and utilities and transforming the grid. And we're grateful to have made a couple of investments there out of our seed and Series A fund. But just to call out, I think it's one, this lens of thematic investing is very much focused on trend by trend, and we'll sort of double down on trends, invalidate trends, revisit trends. And then two, this spectrum of, because we do have a seed and Series A dedicated fund that I don't work on day to day, I think there's a little bit more aperture in terms of, hey, like what are like the seed bets? We're probably doing 3 to 5 companies out of a YC batch that we're like, hey, we want bets here. And then we're able to concentrate and double down on trends and categories at Series A and Series B. The question being like the most overlooked areas, I guess the reason I caveated it is because it's slightly different at seed versus Series B, and we sort of run the gamut there. 2 areas that I feel like we're a bit more invested in than others just by observation. I think one is, within vertical software, I think we really care about proximity to the ERP. Like a lot of times we just invest in the ERP, and again, they might seem like smaller initial markets, but we think you can really compound product. And so we get really excited about that. That's what we call our business in a box thesis. And then there's separately like, hey, if there's already a legacy ERP, a core system of record somewhere, can you really build something that becomes almost like the de facto system of record, or at least like the system of action that's just a wrapper over the system of record, right? Like maybe there's some input output stuff to the system of record, but like for intents and purposes, people are living within your system. And so I think we get much more excited about there within vertical software categories versus I think a lot of vertical SaaS and AI has been having its limelight moment with everybody, but I think it's very much like, hey, fast growth, initial tool, initial wedge. And that's a little bit of difference where I think we lean in a bit more. And I think the second is maybe just on looking at global markets. I just recently did a trip to Europe last month. Europe is having, a great moment with businesses like Lovable, like N8N, like 11 Labs, et cetera. But when I look at, where people have been investing in Europe, particularly the large US multinational funds, it's very much like, hey, just US V2, right? Like what are these global players tackling global markets? I think we really like the idea of, you can start by owning a regional market within whatever category. This generally tends to be more horizontal back office software, but then continue to compound that into additional markets or just go really, really deep. And so I think the rhyming part of both of those is like, we just like focus and care about focus more, even though other people might feel like that's niche or TAM constrained, because of a belief that by being focused, by being and building the best for your audience, you can actually capture so much more wallet share. You can actually compound your market in sneakily large ways. And when you look at it compared to the Base10 story I just told you, it's very similar, right? Like, hey, we're going to be focused. We're going to go a mile deep here. And everybody else is like, what do you mean you're not doing Series C's or Series D's or businesses that look like this or that? It's like, no, it's just by doing this. Like there's so much there and so much richness, and we can build entire strategy and a very performant fund and platform out of that.
I know you're walking the walk because you're a focused guy. You're the Series B guy there. We're going to get to that in a second, but I just want to go back to something you said because I think it's really important context. You made a linkage to how hedge funds think and invest. Can you just unpack that a bit and what the ties are now to investing in private markets and not thinking dogmatically, as you mentioned?
There's a typical background where, studied business and computer science and undergrad and CS grad degree, and then came out here, did investment banking, worked at a large fund for a couple of years. And it was really at this like peak or post-peak COVID period that I left to join a hedge fund, which is where we had met. I was one of the first investors and employees to join. Today is a very successful fund. That was sort of a new launch, entrepreneurial 0 to 1 fund at the time. I was the Silicon Valley, SF private sky, if you will, and everybody else was in New York. And so I was just exposed to this like range of different thinking compared to Silicon Valley echo chamber, tech echo chamber. And I think one that RightRev thought was so helpful because it really shows like how much is just like echo chamber narrative versus the fact of the world, right? Like the things that feel inevitable when you're on the bleeding edge of technology. If you take 7 steps back, you're like, wow, this is so localized. And again, there's a lot of power and signals that are concentrated here, but it's still pretty localized compared to everything else, right? I think the second part of that as it relates to investing is like when you take that like 7 steps out perspective, there's just so much more uncertainty, so much more potential opinionatedness, right? Because I think when you're living just in a narrow segment or I don't know, an echo chamber of sorts, right? Like the things that feel obvious and inevitable, and so everybody flows into these things, right? Like I don't know, like thinking of like AI native ERPs, for example, like suddenly like within Silicon Valley, it feels very, very inevitable. And I think that is not false, but that also reflects in returns, right? Which is like that inevitability translates to competitiveness, translates to cost of capital. And suddenly you have, you know, the 20 marquee venture firms here who are all playing the same game of needing to get into these assets and the price sort of climbs up and doesn't mean they're not successful. Take Wiz and private market security, right? Like very successful $30 billion plus outcome, but pre-revenue, they were valued at over $1 billion. And so you sort of look at that risk reward, you're like, hey, they hit that, you know, top decile case maybe, and that was a 10x for that, not a 100x or more than that you would hope for pre-revenue investment. To collapse it, I think like hedge funds really taught me like, hey, it's not just enough to find great businesses, but you have to find great businesses ahead of consensus or at great prices and valuations. And so I think it added a much more differential lens to my investing. It's not just like, hey, I'm going to play the same game as everybody else and execute better and get in and pick the right logos, but it actually pays off much more if you're an AppLovin investor, right? Or these things that sort of get thrown by the wayside and then compound. Like we find 100x compounders in the public markets. Carvana recently, you know, had that thrown out of the bathwater, came back alive, et cetera. So I think it's all about like, hey, everybody is saying this, so it must be true. And I think public's like, hey, everybody is saying this, like, what's the opportunity for them to be wrong or for me to be extra right? Right. I think that was a really, really nice lens to add to my toolkit.
That's a subtle shift. I really like that. Thanks for breaking it down. Wait, so were you living on the West Coast but doing public markets? What time in the morning would you have to wake up at?
5 a.m. pretty much every morning. I mean, I very much a COVID era thing. And I had a couple other, you know, friends and colleagues go through that private to crossover to public and often back to private journey. This is an aside. I will just say like that was the hardest thing I've ever done. And that's, you know, including raising an infant. That's including graduating with 3 degrees in 4 years. That's including, you know, doing investment banking on Sand Hill, like all of it. Like, man, that Publix experience, you know, credit to my friends who are in that hedge fund world. But for me, it was very intense.
What's the hardest part about it? Is it that you just have to always be on because it can move faster?
Yeah, I mean, I think for me, speaking about the experience, and again, I think it's honestly like a phenomenal fun and phenomenal people that I'm still in touch with. I learned so much. It's a very different type of investing than private market investing. And as I've thought more about it, it's like, man, it's actually very hard to hold both and do both well, partially because of the velocity, because there's always potential liquidity. But like theoretically, it's like, hey, if you're going long only, like a great business is a great business, and you should be able to like better identify great businesses. I think the challenge comes in terms of like the tactical approach of how you invest, right? If like privates are long only, and then this was particularly like a long short startup fund with a great backing and great ambitions, et cetera. But the best example I have is, I don't know, I'm like a pretty good or professional soccer player, right? And I get like drafted onto the starting 5 of an NBA team. You sort of understand the mechanics of like, you got to score points, you got to shoot, you got to pass, you got to dribble. But wait, suddenly like all these things mean completely different things, right? And I'm here trying to like head the ball and it's like, what are you doing? Or like kick it into the net. And obviously, so the completely different shift in paradigm of like what you're actually doing from a day-to-day when you're in the public markets and the private markets, and then compounded by like a long short strategy where there's not really a good parallel to that in the private markets.
That's super helpful to break down. It's a different world to me. So I'll stay in my lane for the most part with the private market. I want to get back to that. So you lead Series B at Base10, and you're sitting right at the edge of venture and growth equity. What's the edge of that Venn diagram?
It's really trying to continue to maneuver in a manner that is, one, authentic to us, and two, overlooked where we'll have alpha in returns, right? And what that looks like for us at Series B today is we're investing in primarily B2B software businesses all over the world that are growing well, call it 150% plus on average year over year, upwards of 300 or 500, 1,000%. Founder run, generally quite capital efficient. 80% of our investments are outside of the Bay Area. 80% of the time, we're the first Silicon Valley or New York investor to even come into the business, right? And so these are businesses that might be backed by local investors or angels or bootstrapped, et cetera. And it's this intersection of businesses and founders that have this great ambition to build a billion or a multi-billion-dollar business in the vein of, Shopify was founded in Ottawa and Toronto-based, right? ServiceNow was founded in San Diego, and Atlassian in Australia, et cetera. Like these types of compounding businesses, but that, again, are like not part of the Silicon Valley ecosystem, not part of the Twitter tech sphere. None of our founders are on Twitter actively, right? And so they're sort of like heads down building. We love that because, again, when you're serving real economy customers, they're not on Twitter, right? If you're serving YC customers, they're on Twitter. So I'm not saying it's bad to be on Twitter or X, but just by nature of like where we invest, and then we're going to them and finding them and proving that we're the best partner to them during, I think, also this like macro shift for a lot of the funds that historically pursued the strategy have changed or evolved it. Take Summit and Excel, where, again, my partner TJ came from. I think both of them have really evolved their strategy, where 15 years ago, they were doing this type of investing quite a bit, and today are doing something a little bit different by nature of their evolving mandates and AUM, et cetera.
Do you think the state of Series B has changed?
Definitely. And even I joined here mid-23, so 23 to 24 to 25. The more it changes, the more it stays the same as well, right? And so I think you sort of have this spectrum of very, very early stage Series B bets. I mean, it can be founder bets, pre-rev, 0, 1, 2 rev, $1 million of ARR, right? And it's very much like thesis, idea, fast follow onto the A. Then you have sort of like a meat and potatoes Series B, which is, I would say, historically Series B is like post product market fit, again, probably correlated to like $5 to $15 million of ARR realm. And you can have like a range of heat. In 2023, there just wasn't a lot of activity whatsoever. And I think it was like a real challenge across like Series A into Series B realm. And there's definitely things that are coming to market that like weren't getting done. I think in 2024, it felt like a bit of a rebound where like a lot of things existed and waited out 2023, had enough scale, maybe they raised an A in 2021. And so like most of these things were getting done, but there was like many more like meat and potatoes type Series B businesses that were getting done. I think if you look at 25, it sort of shifted, again, just by nature of like capital availability and what the folks with capital tend to be doing. There's like more of this like early B thematic momentum, like just need to get in bet. Idea being that if you're a large multi-stage fund, a $20 million Series B is, 1% of your portfolio. Like that's not the make or break. You just got to get in and then play for the C or the D, et cetera. Whereas I do think like the meat and potatoes segment is actually, I'm starting to see things not get done again, right? Or we sort of see a couple of names lingering in the market. And so I think there is certainly discretion, and I don't think it's a hot market, but it's still increasingly bifurcated market, I would say, where you see 100x ARR plus multiples on one end, and then you see, some fundraisers lingering or falling through on the other end.
And I think the good news travels louder and faster. And just from my seat, I'm seeing all these Series A rounds get done. And then 12 weeks later, these companies are raising a Series B that's like 3 times as large. Are you seeing that trend too from your seat?
Yeah, I think that's definitely happening. I mean, I think there's echoes of 2021. I think it's very much sort of what I describe as this like the first category, right? You don't quite have the traditional Series B metrics, but you certainly have, the Series B or B plus style valuation and round construction, et cetera. And really what's happening there is like, you're not actually de-risking things in the same manner as you would a traditional meat and potato Series B, which is like you're really looking for like, hey, you have repeatable product market fit, you have the signs of repeatable go-to-market execution so that you can compound from 5 to 15, 15 to 50, right? I think if you're raising, a Series A and then 3 months later or 3 weeks later or whatever, raising a Series B, like, man, the business certainly has not grown 3x. Probably the business has not changed a lot, but there's so much demand for a certain type of business that, has the right ingredients around technology or on founder or on market that If you're a large fund with capital, you just want to get in, right? And so what's happening is they're sort of pulling that risk curve forward and obviously paying higher multiples mathematically. But it's like that Series B that would have gotten done 9 months later, you're just doing 3 months later and beating everybody else to the punch. You're embedding and taking on more risk. But then, hey, suddenly somebody's doing the Series C, D 3 months later. And what you get to is sort of a 2021 style moment, it feels like, which is you have these companies that are sitting on big valuations that do need to take some time to grow into them. Some of them will, some of them will take a little bit more time, some won't. It's obviously not a ZERP period. It's a declining rates environment. So we'll see what that affects. But it's very much reminiscent to me of 2021 style capital changing or chasing a scarcity of certain profile type of company. And so you just got to get in and you're pulling those rounds forward to deploy that capital and be on the cap tables.
The crazy comparison to me, Jason, is if we just go back 10 years and you look at someone like a Twilio, I think they went public after their Series C. That's a very different Series A, B, C than the A, B, C, D, E, F, G we now see in today's private markets.
As long as I've been in the industry, we talked about companies staying private for longer and longer and longer. And now you have, not just Stripe and Databricks, but ByteDance and SpaceX and all these OpenAI and Anthropic, and, losing track of the digits, hundreds of billions of dollars of market cap tied up in privates. So definitely times are changing. Capital availability has changed. I remember Twilio was my first interview question. I was like interviewing into banking, and that was my first staffing when I joined banking. So very much remember that era. And today, or I think yesterday, maybe there's news that like Schwab bought Forge, right? And just the accessibility to like private capital markets has meaningfully changed to chase these companies that are staying private for so long. Facebook felt like a big IPO in 2012, right? And then, I don't know, Uber felt like a bit like they were private for a long time. And when they finally went out, and that was in the tens of billions of pricing and market cap at IPO. And now it's just continued to grow, and you can raise tens of billions in the private markets. And so I think it still highlights the why and when go public question, that you have tenders, you have liquidity, et cetera. So I do think that's a continually evolving dynamic, but still heading in the same direction.
And if we were to try to strip away some of the hype, I know it is very hard. Traditional meat and potatoes Series B today, what's the size of the bread box for these companies? 10 million, 20 million in ARR, lower, higher, and the growth rate?
Market is where supply meets demand. I know that's sort of tautological or definitional, but I do think it's interesting because like in 2023, there was like no supply of companies because people didn't want to go out to market because the valuations implied would have been so low, right? There's so much pessimism. I think in 2025, what's changed is like, again, when I observe the Series B market, there's just fewer players than 10 years ago, right? Like subsequent funds have been harder for different folks to launch or raise. Certain funds have gotten much larger. And so Series B just feels like a less core part of their strategy. It's different when you have a $800 million fund versus a $3 billion fund, right? In terms of what a Series B check means, right? And again, this sort of follows the track of doing Series D and E and F and G investing. If you look at, there's fewer supplies of capital from my observation. I think that supply still chases a breadth of meat and potatoes type businesses. I mean, benchmarks I would say is like, hey, I don't know, 5 million growing 3x plus is like the lower bound of scale for a traditional Series B. More typically like visibility to 10 growing 2.5 to 3x is like a pretty sweet spotty. I think what would people consider a SaaS Series B today. I think north of that, would be on the larger end. And then again, certainly like growth rate, there's probably a buyer universe at 30, 50, 70, 90% year over year growth. That's less our category, but again, a different set of buyers that will step up for that. Again, I think when companies don't end up raising, it's less so because there's like no demand for those type of companies for the most part. It's more so that there's just like a valuation disconnect, right? Like if you're growing 70%, like, hey, can you actually get to break even and profitable? And like, would you want to raise at whatever dilution that's implied by, the smaller set of buyers at the market? Or would you rather just sort of go forward and control your own destiny a little bit more? And so I think that's more of what's happening from my observation.
I want to talk about back office automation because a lot of the people who listen to this podcast are either the ones with their fingers in the keyboards using these tools. Some people call it the back office. I call it strategic overhead. So the finance people, the HR people, where the real work happens in the trenches. What are you seeing within these workflows that excite you? I know you dropped the terms earlier, system of record and versus system of action.
A lot of where we've been investing, we historically wore it with and still do, like a badge of pride, like all these like the unsexy spaces, right? Like people are busy and doing some open source and again, all the things I used to do admittedly, but we prioritize less at Base 10. And now it's like, oh man, like all of this is like front and center, right? Like what's hotter than, a next gen ERP or a next gen procurement software or next gen payroll or what have you. Again, we really continue to take the approach of, hey, what does our real economy or 99% of the market need and where are they? Right. And I think they are just fundamentally different than a tech buyer based off of the level of existing workflow, the existing technology investment, existing tech debt, right? It's not just a, hey, QuickBooks to X story or not just a 0 to 1 story or something. It's like, oh, there's like really systems in place already. Again, I think there's like a market viewpoint of like, hey, there's going to be a next generation of SAPs and Oracles, et cetera, that are being built. And like, now's the time. I think for us, the approach has very much been like, okay, what are ERPs that are right for building innovation on top of, right? Like NetSuite, they're not bleeding edge, but they're definitely also not legacy. I mean, they were founded 2000s, right? Like born and built in the cloud. And again, there's still plenty of people that are transitioning onto NetSuite. There's people that are transitioning onto S4HANA. There's people transitioning onto Oracle Fusion, et cetera, right? And so I think for us, we look at like, man, if you go into these ERPs, whether vertical basis, you mentioned automotive, right? Like the CDKs.
They do ERPs for pet food warehouses. They do ERPs for gun warehouses. You're like, I can't believe there's a market for that. But then you sit down and you're like, there has to be.
Oh, right. And again, I think this is where we play, right? We're like at the point of like slicing these different Epicor products or these different Yardi products or what have you. But like, hey, like this is a really interesting market with like really strong macro tailwinds behind it that needs innovation. And again, we don't think Epicor is going to deliver it. We don't think these, broadly PE-owned assets are going to deliver it. I also don't think somebody's going to rip out Epicor Eclipse tomorrow. I think on one hand, it's like, hey, the core ERP isn't going anywhere. On the other hand, AI ROI is very real. Right? It's just a different level of accessible when you're sitting on that as your ERP versus when you're going 0 to 1 and all your developers are using Cursor or Cloud Code or what have you. And so I think we really lean into that category on the back office side, right? Like deep integrations into like existing ERP ecosystem, proximity to ERP, ability to like drive that like system of action and then sort of make the system of record, for lack of better terms, like a dummy database, right? That you're doing everything on top of and then continue to capture value from the workflows on top of that. So that's really where we get excited about from the back office workflow automation side. That's not to say there's not also a lot happening in that very AI native realm that, our seed and Series A team is certainly spending more time on, and then the rest of the market is also spending a lot of time on.
You got a lot of ERP nerds nodding their heads right now.
It's a great audience for what we do. Hit me up and share perspectives. We're always excited to talk to stakeholders and operators and customers, because that's who our customers or our companies are trying to serve, and that's what we're trying to understand the best to be able to preempt and really invest and provide the capital for your audience to have the best tooling that they can be using.
Jason, I'm going to take you into what we call our long ass lightning round.
All right.
The answers don't actually have to be quick here, but more chaotic day, App Dynamics selling during what you thought was an IPO process during your banking years, or shorting the SaaS market mid-2022 while everyone else was still indexing long?
Of the two, chaotic day, probably AppD. It was actually sort of nice. I mean, I was about to like jump on a flight to Kansas City and then New York for pricing. And again, they sold to Cisco for $3.7 billion and just stayed home. So that morning was hectic. I was like, oh my gosh, what's going on? And then looking at the news flow, but got to be more chill. Shorting SaaS, we already talked about that. The hedge fund experience, probably the most chaotic year of my life. Just because, the investing norms of tech-oriented hedge funds and the market overall just, topsy turn in 22, right? And part of that was private. Part of that was also just public everything. Or like it's a circular loop where privates were valued at 200 times ARR because Snowflake was trading at 70 times forward, and suddenly Snowflake trades at 15 times forward, and that's a big dislocation, right? And you can have a view of like, hey, where are we in the cycle, or why is this happening? But it was the first time I'd seen it to that degree, right? Like you have like 2016 flash crash, you have 2020, but this felt like very like, oh, could this be the end of, I don't know, like tech hegemony as we know it? And then obviously something very different happened with AI and where we are today and Max 7, et cetera. But in 22, it was an uncertain time, just felt unclear where the world was going to go.
What do they say? The market can stay irrational longer than you can stay rational?
Yeah, then you can stay solvent. If you're shorting, you can very much run out of money before, Tesla cracks or Palantir cracks or GameStop or whatever it is, as people experience.
Next one I got for you. I hear you're big into fantasy football. So what types of leagues are we talking? Are these keeper leagues? Are you a snake draft kind of guy? Break it down.
It started innocuously as a way to keep in touch with college friends. It's since been a great training ground for investing. What does everybody believe, and like where are they wrong that you could be right? And you're sort of like taking bets. I mean, maybe I'm the only one that does this. Maybe people are just like auto drafting and like, hey, playing the office pool or what have you. But for me, it's like, yeah, like what do people believe that isn't necessarily the case? And like, how can you take an opposing viewpoint and how can you be right, hopefully? And I think that there is an element of, hey, you need upside. You're trying to construct an optimal roster and very clear data points of like if you're right or wrong based off of all the like football analytics and the actual points scored, what have you. But I go pretty deep on it now. I mean, I started like vanilla snake ESPN style league into 2 quarterback and super flex and a keeper. And now I'm in like multiple dynasty leagues of all different sorts. And I think that I have a lot of fun with it. I probably spend, too much time on it. And there's a lot of like good learning. It's like trading with league mates. I feel so prepped for term sheet negotiations that I know how to like go back and forth. And it's like low stakes negotiations. I think with Dynasty, you're taking bets on rookies and young players in the same manner that you're like betting on startups. And so you sort of have to like shift the model of like, hey, we're not just investing for value, right? We're not just investing when it's a 10x error multiple. We're investing off of like, really we're investing off a 7-year discounted equity value, but we're investing like, hey, of what it could be on the company side. And then similarly, like rookies, you're not valuing the production or performance today. You're thinking about like, hey, like what could this become if things go right? And like, what is the right price to pay? But I do think it keeps me sharp on my game. And I just have a lot of fun with it.
Give us one non-consensus pick.
Maybe 2 learnings. These all date back to what was probably like 21 or 22 season. I picked up Amon-Ra St. Brown, who's a wide receiver on the Detroit Lions, off of like waivers. Like his rookie season, he had like a bad, first half, like picked him up as a great like end of the year. I'm like, hey, this seems like there's something here. And it was just tremendous keeper value for like the next 4 years. That was like a trust momentum story, I guess. Conversely, that same year, I had like no idea what I was doing because I wasn't playing Dynasty. I drafted Jamar Chase and I traded him for peanuts because I'm like, oh, I need a running back. Like I don't need this rookie wide receiver. And that was probably the ultimate, keeper value for 5 years and would have dominated that league. And it was like, okay, that's regrettable move, but learnings from that as well. And I think I've since gotten much better at sort of evaluating earlier talent and paying attention to these things.
Jason, you get a lot of career advice requests. What's one thing that you tell people that catches them off guard?
I think like I start with, do you know what you want to do or not? Right? I personally didn't know what I want to do. And even now there's like all sorts of things I'm interested in, but it's like, hey, if you like don't know what you want to do, you obviously want to like get exploration and sort of like test and tease and learn. While like, you want to build optionality, like meets building like long-term compounding as the North Star. But if you do know what you want to do, I think like the answer is like just like the shortest path tends to be the direct path. And I mentioned that particularly for like this realm of investing, because a lot of people are like, hey, like I want to be an investor one day, but I'm going to go and I don't know, work in operating for a little bit, or I need to like be a successful like exited founder, et cetera. And so like there's like a lot of different paths to this realm. Years ago when I was starting in the industry, I was talking to Sarah Guo, who was a Penn alum and sort of went Goldman into Greylock into now our own fund. And she was like, yeah, like the best way to learn is just like do it, right? And so I think that is maybe a little bit less conventional. If you know where you want to go, like the shortest path is the direct path, right? And then the second thing that's been a really helpful lens for me, also shared by another mentor early on, it's just like leaning into fear, right? What is the thing you're most afraid of and identifying that in a decision, and then just like either taking that off the table or leaning into that. And I think those are pretty broad-based advice pieces. But then I also bring in a third part of like, hey, just like identity and what matters. And, this is just one small part of everything, right? Whether it's family or faith or whatever else you have going on. And certainly this isn't all the end all be all.
Yeah, my job is something I do. It's not who I am.
If there's an ability to find fulfillment and joy, I feel incredibly fortunate that I fall into that category. But there's also lots of different ways to find fulfillment and joy and meaning outside of having, the perfect job or whatever it is that people are looking for. And I think that's important to remember as well.
Last one I've got for you. What's one thing you believe about venture that would get you kicked out of the group chat?
Incentives drive behavior, right? And I think like incentives have changed over the last 10 years in venture. I mean, I think it nets out as like, man, I feel like it's really going to be hard to compound returns at the venture stage or the growth stage, right? Like, I don't know how many firms, not even be like S&P, but if you just like invested in like Mag 7 or like Mag Cap Tech, and maybe there's a survivorship bias there, or just like NASDAQ or QQQ, right? It's like pretty hard to beat benchmark returns. And I think even more so now with the level of competition, like the level of valuations being paid, et cetera. And I just think it's like a different game, whether you're an LP allocator, whether you're an investor at whatever stage in your career, of like what you want to be doing, right? Like there's definitely different ways for different people to win.
There's this funny flag in like this college dorm. It says, we do this not because it is easy, but because we thought it would be easy.
That's how the gateway drug and how everybody gets started. And now we're so deep into it. I definitely think returns can be made on a localized basis. And I think there's generational businesses that are going to be built. And then I'm so excited about backing the next generation of great entrepreneurs building for the real economy. I mean, I think there's still a huge amount of alpha there. I also think it's not as easy as it might seem, or it did seem to me 10 years ago. So here we are.
Well, thanks for joining me on the pod, and congrats on all the success. It's fun to follow you, man.
Been looking forward to this and glad to get this one in the books.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds, and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.